In the previous lesson, we looked at the actual mechanics of the market, of how order flow, so the interaction between buyers and sellers, that battle of supply and demand, is what actually leads to the price action that we then see on our charts, right? So now what we're going to do is look at how we actually draw and identify these areas of supply and demand in the market on our charts, and how we can use them as high probability trading opportunities when we then combine them with everything that we know so far about market structure. Now, time doesn't know price, and price doesn't know time. I know at first that sounds like some kind of silly little riddle that you might be trying to get your head around, but it's actually quite simple in reality. So as retail traders, we can get quite caught up in our world of technical analysis and looking at candlestick charts all day, and we can be forgiven for thinking that everyone who participates in the forex market, is trading it in a reasonably similar fashion to the way that we kind of think about and look at the market. But when you actually kind of take a step back and you think about what we just discussed in the previous lesson on market mechanics, and you think about the order flow in the market, right, the $7 trillion that go through the market every single day, there's literally no way that a human brain can even begin to imagine just how much money that actually is. Big institutions who are pretty much making up the majority of that order flow, they're not necessarily sitting there, trading with a chart and analyzing, waiting for those candle closures. They're just putting their orders through the market, and they're just facilitating those transactions. So a lot of those big dealing desks at banks, they're just working through commercial volume that comes through to them, to facilitate those transactions, for various and endless amounts of different reasons. You then also have pretty much complicated algorithms that are continuously layering orders in and out of the market, whether that's for pure speculative strategies, from the quantitative side, or even from market makers whose job it is to provide liquidity to the market, etc. There's a lot going on. We don't need to understand and talk about all of it, but what we can do is we can make sense of all of that kind of complicated interaction and the interplay of all of those orders, of that battle between supply and demand, between buyers and sellers. And we can do that with candlestick price charts. So the first step to doing this is really by understanding what a range is. So a range on a price chart is just a sideways consolidation or correction. So it's when price is just moving sideways to the right of the chart. It's not really moving in any sustained direction, and it's not breaking the swing high or the swing low. So it's just ranging in between two of those swing points, and the trend has pretty much paused. So buyers will be stepping in when price is in the discount half of the range, and sellers are stepping in when price is in the premium half of the range. Now, ranges can obviously be found across all time frames, and this is where sometimes jumping up a time frame, it can then show you more clearly that price is actually stuck in a range. If sometimes you're a bit too zoomed in on a lower time frame. Now, ranges generally indicate one of two things. One being high volume order flow, where many orders are changing hands, and it's very likely that large players are beginning to stack orders at a fair value of price. So this is what you will often hear traders refer to as an accumulation or a distribution of orders, which basically just means that demand and supply are exchanging quite rapidly, but eventually you do see a large expansive move that breaks out of the range, either to the upside or to the downside, depending on which side of the market is in control. So when the market deems that price is at fair value, orders can be exchanging at quite a rapid pace, and this is where you won't really see much movement on a price chart. But then eventually, when that imbalance between supply and demand eventually arises, and it will eventually arise, that is when you will then see price move rapidly in one direction. Why? Because it's trying to seek more orders, right? Price needs to seek more liquidity in order to fill that imbalance and bring the market back to an equilibrium of fair value between buyers and sellers, which is where price will then form another range, right? Until the next imbalance then arises, which will then cause price to break out of that range to then seek more orders to fill that imbalance. And then this whole cycle that we've just described, the whole cycle of order flow and that relationship between supply and demand, is essentially that continuous heartbeat of the market. So the other end of kind of what can form ranges, I guess the other end of the spectrum, is low volume. Now, naturally, high and low volume are going to be very, very different in nature, and the fact that ranges are created by both of those environments can obviously be a little bit confusing. So one kind of common time which you'll see a range is sort of towards the end of the New York session, as the session is closing and moving into the Asian session, where price tends to range and consolidate because there tends to be kind of low market volume during those times. And that generally, goes the same for the whole of the Asian session, where volume is typically lower than, comparison to London and New York. So Asia tends to be quite range bound compared to those sessions. So kind of session timing is, I guess, one of the obvious ways in which you can just assume that if you see a range, right, it's during Asia, that it's typically because of low volume. But how can we tell whether a particular range, aside from session timing, how can we tell if a particular range is caused by high or low volume order flow if ranges are created by both of them? Well, the easiest way to determine, which environment you are dealing with is by just waiting to see what happens after the range is created, right? So we don't have to guess, we just wait. And then we ask ourselves, does price rapidly move away from the range, or does it just slowly move away from the range? Because rapid movement away from the range, that suggests high volume, which implies that a lot of orders have exchanged hands, and that was likely institutional backing, because it takes a hell of a lot of money, just to move any of those major currency pairs by even just 1 pip. So, if we see price rapidly break out of a range, then that gives us our first clue of, a footprint that a large financial institution has stepped in, or of course, many of them, and that is what has caused that overwhelming imbalance between supply and demand, right? To cause price to break out of that range. And then what we can do is start to potentially frame a trade idea around this when we see that occur in the market. But if you see quite slow movement, price sort of just trickles out away from the range, then that will typically suggest low volume, and that there hasn't been that really significant imbalance between supply and demand, which is what really we are looking for. Because remember, the whole game we're kind of playing here with supply and demand is to look for where the big money stepped in to take control of the market. And we want to use that to understand where price is likely to move to and move from, because that gives us another framework in order to read the order flow. So again, a movement away from a range should be significant to clearly showcase momentum being injected into the market. So if price moves out of a range and then sort of immediately retraces afterwards, that can be, not always, but can be further evidence of low volume. So therefore would not be the creation of a supply and demand zone that we really should be interested in. So we are not looking to trade that initial move, that initial breakout of the range, but instead we are concentrating on the retest of that range as price eventually looks to return to that area. So range created demand is when we see that sideways range followed by a rapid expansion to the upside, and then we look for a move back into that overall demand zone to mitigate and fill any of those remaining buy orders that may be left in that area of interest. So then we can look for another potential bullish move from that price level where that huge demand initially, stepped in previously. So again, we don't trade the initial reaction out of the range because we never know for sure which way, price is going to break out of a range. So keep it easy. We just wait for the market to show its hand and tell us which way it wants to go. And then what we do is we patiently wait for price to return to that demand zone. And then we start to look for our entry models within that zone. So obviously the same thing goes for range created supply. We see price breaks out of a range to the downside, clearly indicating that in this case, supply managed to completely overwhelm demand, right? Because it causes that imbalance to the downside. So we wait for price to return to that range created supply zone, where then we look for potential entries to short the next move from that area where there is a lot of supply interest. Now, the second type of demand and supply zone that you will see is pivot created zones. So in the case of pivot created demand, you will see a sharp down move followed by a sharp retrace to the upside. So what's happening here is that supply is in control as price is moving down, and then suddenly an overwhelming amount of demand steps into the market, causing price to then rapidly reverse to the upside. And that creates that demand zone that we are now interested in, and we wait for price to return to that pivot demand zone to look for potential long entries. So then pivot supply is obviously the same, but the opposite, where we see a small sharp movement to the upside that is then rapidly reversed with an expansive move to the downside, showing that demand has then overpowered supply, causing that imbalance to the downside, where we will then look for price to return to that pivot created supply zone to potentially look for short entries. So these ranges and these pivot created zones, these really are the footprints of institutional orders in the market that shows us where they are stepping in with large orders to cause those imbalances. Now, we never need to guess. We literally just wait for the breakouts to occur to create those supply or demand zones, and then we await the return to the zone in question, and then we look for potential entries there once price gets there, because the probability, it's not a certainty, but the probability of price causing a similar move as it mitigates and fills the remaining, those large passive remaining orders that are sitting in the order book at that price level, that gives us a very strong edge in the market for us to potentially surf on the coattails of that large institutional money entering and exiting the market that causes those huge imbalances and therefore those huge moves for us to capitalize on. Now, as we go on, of course, we will cover entries in a lot more detail and how we use the lower time frames for confirmation and refinement, etc. But for now, all I want you to understand and all I want you to think about is just how these zones are created and how they form in the market and what they represent. Because remember, all these zones are doing is they are visualizing the action of the order book, so that order flow, and that's the language of the market that we are essentially reading with candlesticks on our charts. So now we understand the concept of how these zones are created with these range and pivot zones, but how do we actually see and draw these on our charts? Well, as you can see here with candles, if it is a range created zone, we just draw our zone to cover the entire range. So we draw from the lowest point to the highest point of the range before where price rapidly then broke out of that range. And it's the exact same, whether it's supply or demand. For pivot created demand, we draw the zone from the bearish candles that are then engulfed by the bullish candle that breaks out to the upside. So we sometimes refer to this as the sell to buy. For pivot created supply, we draw the zone from the bullish candles that are then engulfed by the bearish candle that breaks out to the downside, and we sometimes refer to this as the buy to sell. So that's how they both look when we map these on our candlestick charts. Now, whether a zone is a supply zone or a demand zone, that will always be categorized by which direction price breaks out of the range. So if price breaks out of a range or pivot to the upside, this is caused by demand, right? Giving us a demand zone. And if price breaks out of a range or a pivot to the downside, this is caused by supply, giving us a supply zone. But what determines if those zones are continuation zones is essentially which direction price was traveling in before the zone was created. So for a demand zone to be a continuation, price will be bullish and moving upwards before the zone is created. So then when demand breaks out of that range, it is a continuation of that bullish trend, right? So for a supply zone to be a continuation, price will be bearish and moving downwards before the zone is created. So then when demand breaks out of that range to the downside, it is simply a continuation of that bearish trend. So for a zone to be then classified as a reversal, again, it just solely depends on which direction price was moving before the zone was created. So in the case of demand, if price was bearish and moving to the downside, and then demand stepped into the market to overpower supply, causing a bullish move, this is then a reversal against the previous bearish trend, right? So that demand zone essentially becomes a reversal. So therefore, in the case of supply, if price was bullish and moving to the upside before the range or pivot was formed, then when supply steps in, causing price to fall to the downside, this is a reversal against that previous bullish move, right? So, if I flick between kind of these continuations and reversals, you can just clearly see that, supply and demand are always in the same direction. It's just what direction price was moving in previously before those zones were created that determines whether or not you classify it, right, as a reversal or a continuation. So again, just to quickly summarize, we have two main types of zones, either range created or pivot created supply and demand. Range and pivot are essentially your two main types of zones, but a pivot created zone can also be just one candle, so it doesn't have to be multiple candles. And you can also then have what is called a fractal zone. Now we'll talk about these fractal zones in a lot more depth in just a minute, but essentially you are refining the candle to just the wick, as this will be a zone on a lower time frame. So this is how all four of these types of zones would look like as continuation supply zones. And then this is how all four of those types of zones would look like as, reversal supply zones. So it's always supply no matter what, because price broke out to the downside. But what determines whether it's a continuation or a reversal is again just dependent upon which direction price was moving before the zone was created. So we've seen how these four zones could look like on their own, whether it can be a whole range of multiple candles, or just a sharp pivot where you have a few or just one candle, and then finally when you can refine that further to just the fractal wick. But all of these four types can also be refined from just one range. So if you see this range on the far left hand side of your screen, you can draw your zone from the entire range, right? Drawing the bottom of the zone from the lowest wick all the way up to the highest point of the range to the highest wick. But then you could refine that exact same range to just the pivot point of that range before price broke out, where you can see that supply stepped into the market, right, in the second example. So essentially you refine that whole range to just those last two bullish candles where you get that pivot, where you get that buy to sell that broke out of the range. You can then take that pivot and refine this even further to just the last single candle of that pivot point within the range. And then finally, if you want even further refinement, you can draw the supply zone from just the wick of that last bullish candle of that pivot point within that entire range, okay? So you can just see how going from left to right, you can see that they are all the exact same price action example, but you are just refining it further and further as you go across to the right. So why would we bother to refine zones just like this? Well, it all has to do with our trade entries really. Now we're going to talk about entries in way more depth in future lessons, but for now it is a bit of a good time to just start looking at and just conceptually thinking about how we will use supply and demand zones to place and size up our entries. So essentially we will be looking to always, no matter what, always place our stop loss behind the zone. So in this case, because it's supply, we are expecting price to have a bearish move when price returns to the zone. So we would place our stop above the zone, above the highest point of that range. So if it was demand, then we would place it below the zone, right? So that's pretty simple for stop loss placement. It always goes behind the zone, which is nice and mechanical. Now for where you decide to place your entry, you have a little bit sort of more freedom and choice, but essentially you will look to enter anywhere on or within the zone. So the lowest point that you would look to enter the supply zone is at the distal point, which is the very start of the zone on the outer edge, just like how the reward to risk tool is drawn here. But you can enter anywhere within the zone, so you could enter higher up. But again, I don't want you to worry about this right now. We will talk about that a lot more in future lessons. So for the purpose of this lesson, we are just always going to enter on the distal, which is the edge of the zone, okay? So our stop always goes behind the zone and our entry always goes on the edge of the zone. So going back to why we could potentially refine our range zone to either the pivot, the candle, or the fractal refinement, the reason why, as you've probably already guessed, comes down to reward to risk. Because as you can see, if we refine that range supply to just the pivot supply of that range, then this means that we will be looking to enter our short position slightly higher up at a better price, but keeping our stop loss in the exact same position. So this means that our stop loss will be slightly smaller compared to entering on the entire range supply. So ultimately, this improves our reward to risk ratio. The next refinement from there is drawing the supply zone from just a single candle within that pivot. And you can see that again, this will improve the reward to risk of the trade. And then finally, refining all of those supply zones to just the wick to give us that fractal refinement. That will give us even higher potential reward to risk. So that's great, but you may now be wondering, if the fractal refinement gives us the highest reward to risk ratio, why wouldn't we just always draw our zone that way? Why bother drawing a much bigger zone on the entire range? Well, to be fair, that's a pretty good question, because the reason why is that, of course, there are zero guarantees that price is going to pull all the way back up that far to actually tag you in and enter you into your position. Because we don't know for certain, where the largest amounts of orders are sitting within that supply range that will be enough to overpower demand to start the next bearish leg down in price. It could literally happen at any point within that range when price gets there. So the more that you refine a zone, the more you increase your potential accuracy giving you higher potential reward to risk, but it increases the probability of you not being tagged into a position, and you may miss more trades compared to not refining. So, it's that delicate balance between improving your reward to risk ratio as much as possible, but still making sure you are entering enough positions. Now, of course, there is no right or wrong balance. This will be entirely dependent on each individual trader. What makes most sense to you, what you have the most success with, what aligns most with your trading personality, and ultimately what you find easiest on your own individual psychology. Because some traders may suffer quite bad with FOMO, with fear of missing out, and maybe they would prefer to just enter more positions and they just want to be in the trade so that they don't miss the move. So they may actually prefer to not refine that much, and they will always take the entire range, for example, or maybe even just a pivot of multiple candles. But then what they have to do is they have to accept, right, that their average reward to risk ratio may be lower than a trader who chooses to always refine their zone to, say, just a candle or even a fractal refinement. But the trader who does refine and prefers that higher reward to risk, they then may have to accept that they're probably going to miss more positions compared to the trader who doesn't refine, right? So it's that balance between kind of over refining to get the higher risk reward and then potentially getting less entries. But again, don't worry too much about this right now, because we will talk about entries and refinements a lot more as we go along. For now, I just want you to really understand the different ways in which valid zones can be drawn, okay? So now what we're going to do is we're going to look at a few more examples of fractal refinements that we can use as valid zones within the market. So we have range created supply and pivot created supply, right? And we've been thinking about things so far just in terms of one single time frame. But now what I want you to start thinking about is multiple time frames and how these different time frames will be interacting together, as we go through and flick through those different time frames. So if we look at the range created supply on the left hand side, let's say for a second that this is the 1 hour chart. So we draw our supply zone on the entire range there on the 1 hour chart. And now I want you to imagine how you think that would then look like on your chart if you jumped up to the 4 hour chart. Well, those 4 1 hour candles that we have drawn the entire range on, those 4 1 hour candles will make up one 4 hour candle, right? So if you jump up a time frame to the 4 hour time frame, you will see that that 1 hour range supply is actually a 4 hour single candle pivot supply zone. All right, it's a bit of a mouthful, but you can see that essentially on the 1 hour you would have 4 candles, and if you jump up to the 4 hour time frame, that will then just be made into one 4 hour candle, okay? So this is what I meant at the start, with that kind of silly riddle that time doesn't know price and price doesn't know time, because it's just orders going through the market, right? That interaction of supply and demand, that battle between buyers and sellers. But we then use candlestick charts and different time frames to sort of make sense of all of that order flow. So if you see a range created zone, as you then go up the time frames, that will then be refined to even, a few or even just one single candle, right? So that lower time frame range will very likely just be one higher time frame candle. So ranges or pivots are the two main ways in which we look at supply and demand zones, right? However, we can essentially anticipate and see where a pivot or range created zone may be on a lower time frame, and we can sometimes see where they are on a higher time frame. So these three examples here are essentially ways in which we can draw zones on our charts that represent pivot and range created zones on a lower time frame without even having to go down and actually view that lower time frame. So the first example here is what's called an inside bar zone. So an inside bar is very simply a candle that does not break the high or low of the previous candle. So you can see in both of these examples of inside bars that the white candle does not break the high or the low of the candle that formed before it. So that's why it's called an inside bar, because it forms inside the high and low of the previous candle. So what that means is that when the inside bar forms, that will be a range on a lower time frame, because it's not breaking the previous candle's high or low, right? So it's just ranging in between, and that's what the inside bar represents. It represents a range on a lower time frame. So when price then breaks out of that range with the following candle, that will then create our zone, as there is then an imbalance between buyers and sellers as price then breaks out of that lower time frame range. But we can see all of that lower time frame price action by simply just understanding what an inside bar is. Now, an inside bar can be bearish or bullish. It doesn't matter in terms of supply and demand. So that's why I've deliberately drawn the candle as white in both examples here, just to make that point clear. That it doesn't matter if the candle is bullish or bearish. All that matters is that it doesn't break the previous candle's high or low, and then that means that it is a range on a lower time frame. So what then determines whether that inside bar is supply or demand? It isn't whether it's a bullish or bearish candle itself, but actually what happens next. Does price break out of that lower time frame range to the upside? If so, then that inside bar is a demand zone. Or if that lower time frame range breaks out to the downside, then that inside bar is a supply zone. So whenever you are looking at fractal refinements in general, if you just ask yourself, how did those series of candles form? That should help your mind to kind of understand what may be happening on a lower time frame. So for the inside bar, you can see that price moved in one direction, then it paused, it failed to break the high or low, so it must be ranging on a lower time frame, and then price initiates out on the next candle. Now in the next example, we have what are called sell to buy wicks and buy to sell wicks. So if we look at the sell to buy wicks example first, at the top, this is a continuation demand zone. So if we ask ourselves, how did these candles form? Well, price was initially bullish, right? It's moving to the upside in that first candle. And then you can see that that candle pulls back ever so slightly because it leaves a little wick. And then that candle closes where that body ends, right? So it closes a bullish candle. But then the next candle opens up where the last candle body closed. But price continues to move down slightly, right? So it's still pulling back since that initial wick formed. So price then goes up so that the second candle closes with a big bullish body. So essentially what just happened is that overall move between those candles is clearly bullish, but there was a tiny pullback in between those two candles forming. So what that may look like is something like this on a lower time frame, where it would show a clear pivot demand zone. So if you imagine those two big bullish candles that we were just talking about, let's say that they form on the 4-hour chart, and then you see those sell to buy wicks, you can then draw a zone from those two wicks, as that will very likely be a demand zone on the 15-minute time frame, for example. And that could look like this pivot demand zone on the right, or it could even look like a range on the left. So it doesn't really matter, if it's a range or a pivot zone. All that is really relevant is that those wicks, those sell to buy wicks, those wicks represent a demand zone on a lower time frame. So if you can see a lower time frame zone that is also visible on a higher time frame, then in theory, all other things being equal, this could make that zone hold a little bit more weight, right? Because let's say that lower time frame zone was an M15 zone, for example, on the 15-minute time frame. That is now also visible on the 4-hour in this case. Now, lower time frame zones will not always be visible on the higher time frames, but when you can see, for example, that M15 zone on the 4-hour via a fractal refinement like that, in theory, that should increase the strength of that zone. And then all of that we've just spoken about, of course, applies to supply zones. So where you have two bearish candles, for instance, that then form those buy to sell wicks. And then on the lower time frame, those wicks will represent either range created or pivot created supply. And then the final example we have here is when we have large wicks. So if you want to refine this further, right, because you want to make your zone smaller to increase your accuracy, to increase your reward to risk ratio, then you can just simply draw the zone covering only the wick rather than including the body of the candle too. And the reason why we do this is because that wick will contain a zone on a lower time frame. So when we hop on the charts and we start drawing on supply and demand zones, these fractal refinements can be very powerful and useful, whereby you can really understand and see that on one time frame actually what is happening on a lower time frame without even having to go down and look at it. So now we've seen how supply and demand zones are created and how we draw them on candlestick charts. However, S&D zones are literally going to be everywhere, right? So if you hop on your chart and you start drawing every single zone on, your chart's going to be an absolute mess, right? It's going to be a shit show, and you're going to see some zones play out and you're going to see a lot that don't seem to work that well, and it's just going to be really, really confusing. Because supply and demand zones are literally everywhere in the market. Why are they everywhere? Well, because there are constantly imbalances between supply and demand. Because if there wasn't, the price would never move. because it would just be at a fixed, constant fair value. Because of course, in reality, what the market deems to be fair value is shifting every second of every day. So the balance between supply and demand is shifting constantly, right? Now, every single supply and demand zone, it probably will form some degree of a reaction, right? When price returns to that zone, you will almost always see price at least pause, or maybe even form a small bounce as those orders are exchanged between hands. And of course, there will be some circumstances where price will just smash straight through. But what we can do to filter out a lot of these zones that are most likely just not going to be worth the risk of trading, right? Because we don't just want to enter a position and risk our hard-earned capital on just sort of any old zone that was created with, not a lot of money behind it. That is not professional trading. That's just gambling, right? If you want to do that, go chuck your money on red at the casino. You probably have better odds. But we are here to be professional traders and to determine and refine our edge. So there are certain confluences that we can look for to increase the probability of the zones having a large reaction or at least causing a larger move. So one that we've looked at in depth so far is market structure. So hopefully you should be very, very familiar with this now. So we've seen how we can use market structure to very effectively give us a bias on the direction of price, whether it is bullish or bearish, whether it is a pro-trend run or a counter-trend pullback, and of course bringing an entirely new dimension to that by using multi-time frame analysis to look at market structure across multiple time frames, to really build that story and that overall narrative. So market structure is a very important tool that we can use in our analysis to help us make sure that we are trading on the right side of the market, and that will increase the probability of the zones that we are looking to trade from, causing the type of large moves that we actually want to position ourselves in. So market structure will help us to manage our expectations of how far the move from that zone is likely to reach before price may potentially pull back or even reverse. So that's why market structure is king. We then looked at the concept of premium versus discount, so essentially helping us to see if we are looking to trade at a level that is actually well priced. So if we introduce supply and demand to this, we can then look to buy from demand zones in discount prices and sell from supply zones in premium prices to help increase our strike rate and potential reward to risk ratio. There are then some other very key concepts such as liquidity sweeps and mitigations, which we haven't discussed yet and we haven't looked at yet. So don't worry, we will look at these in depth in future lessons. So you don't need to concern yourselves about these just now, but these are also some key confluents that can help us to kind of pick and choose which zones that we are actually interested in building solid trade ideas around, okay? Now, all of these are really great confluents that we should be using to make sure that we are trading with as high as a strike rate and as high as a reward to risk ratio as possible. And those confluences are really nice to have, but they are not necessarily a strict minimum requirement. So what do I mean by that? Well, if they were a strict minimum requirement, then you would only ever buy from demand zones that were in the discount, for example, and perhaps you would only buy from demand zones that were also pro-trend and in the discount, right? Because that should, in theory, really give you that higher probability. But what that also means is then, you would never sell from a supply zone that was in the discount prices and maybe a supply zone that was also counter-trend, because this would be, I guess, as low probability as you can make it, and it would be a lot more aggressive. But the reason why, I don't say it's a minimum requirement that price, needs to be at a good premium or a good discount level, or it has to be with pro trend and you can't trade counter trend, is because you can do those things if you want to. It will be a bit more aggressive and might be lower probability, so I wouldn't really advise it if you're starting out. But they're just not hard and fast rules. So that will all depend on each individual trader, on how they wish to trade, what makes sense to them, what they have the most success with, what is easiest and congruent with their own trading psychology, which again will only come with time, experience, testing, and constant reviewing. So, as I was saying, that list there are all confluences that increase the probability of supply and demand zones playing out with large and sustained moves, but they are not necessarily a strict minimum requirement to validate a zone that you may want to trade from. But there are two core methods that we use to validate a strong supply and demand zone that, in my personal opinion, you should really only be looking to trade from zones that at a minimum do at least one of either of these two methods, or ideally both of them together, in order to trade from them. So what I mean by that is I personally view them as a minimum requirement in my trade plan, so I would advise that you probably do also. So what are these two core methods? Well, again, because we want to find the zones where there was a drastic imbalance between supply and demand, so that when price returns to it, the probability of that big money stepping in again is a lot higher, right? Because those are the areas that we really want to concentrate on, that we want to focus on, and that we want to trade from. So again, what can we do to try and validate which zones are going to be the strongest, which zones are going to be the most significant, and therefore have that highest probability of causing a strong move? Well, the main idea is to find a zone that achieved something significant in the market. So there are two main things that we look for that we deem as significant in order to validate a strong zone. The first of those is that we want to find zones that caused a break of structure. So we want to see the zones that led to a boss. So we want to find whether demand came into the market that led to price being able to break structure to the upside, to break a high and form a higher high. And likewise, we want to find whether supply came into the market that led to price being able to break structure to the downside in order to break that low and form a lower low. So we should know by now that there are three different types of structure: swing, minor, and substructure. So the more significant a level of structure that a zone manages to break, then the more significant that zone will be. So with swing structure being the most significant of the three, minor structure being less significant than swing structure, and finally substructure being the weakest out of those three. So this means that the highest probability zones will be the ones that lead to the break of swing structure. So the demand zones that cause those swing higher highs, or supply zones that cause those swing lower lows. Now all three zones, boss, M-boss, and S-boss, can of course be tradable, but it's the swing zones that are going to hold the most weight and have the highest probability of leading to another large swing move. And it's those swing runs that really we want to catch and position ourselves in. So that's the first main way in which we can validate the significance of a supply or demand zone in the market, by concentrating on the ones which caused a break of structure. And the second main way that we use to validate zones as doing something and achieving something very significant in the market is if a zone actually manages to overpower and take out another strong valid zone, causing that zone to fail. So we call these flips, so supply to demand flips, or demand to supply flips. So when you find a zone that combines both methods, so not only does it cause a break of structure, but it also caused another zone to fail in the process, then this is when you have the highest probability zone, all else being equal. So let's just do a super quick crash course summary of everything that we have covered in this lesson. Supply and demand zones are caused by overwhelming imbalances between supply and demand, and we can identify and draw these on our charts by seeing where price broke out of a range. And this can be in the form of range or pivot created supply or demand. And of course, we don't trade the initial breakout. We instead wait for price to show its hand and see which direction it wants to go. And then we wait for price to return to that zone and then look for our potential entry models. So we look to buy from demand or we look to sell from supply. Now, what determines if those zones are continuation zones is which direction price was traveling in before the zone was created. So price will be bullish before a demand zone if it's a continuation, and it will be bearish before a supply zone if it's a continuation. If it's a reversal, then price will be bearish before the demand zone or bullish before the supply zone. Range and pivots are your two main types of zones, but a pivot created zone can also be just one candle. It doesn't have to be multiple candles. And you can also then have what's called a fractal zone. But all of these four types can also be refined from just one range, and we can see that here from left to right. We look to enter on or within the zone, and our stop loss will always go behind the zone. But the more refinement of a zone does lead to increased accuracy, giving us higher potential reward to risk, but potentially more missed trades if price does not pull back that far. So a range created zone, or even a pivot zone that has multiple candles, that will essentially be a pivot on a higher time frame. So that lower time frame range can generally be cleaned up and refined to a single candle if you were to jump up and view that same price action on a higher time frame. We then have three main types of fractal refinements. Inside bars, where the candle does not break the high or low of the prior candle, and it is then engulfed by the next candle. So this represents a range created zone on a lower time frame. And we don't care if the inside bar is bullish or bearish. It's irrelevant in terms of supply and demand. We're just looking for which way price moves after the inside bar forms. So if it breaks out to the upside, it's demand, or to the downside, it is of course supply. Then we have sell to buy and buy to sell wicks, which represent a pullback on a lower time frame. So within those wicks, there will be a pivot or range created zone on the lower time frame, which is visible as those wicks on the higher time frame. And then finally, we have large wicks. There's always pretty much stuff in wicks, so if you refine your zone to just the wick, this will be a range or pivot created zone within that wick on the lower time frame. Now, supply and demand zones are literally everywhere. Almost all of them will give some form of a reaction, but not all are necessarily one in which we want to risk our capital on and take a trade from. So of course we build a portfolio of complements and evidence for each trade to increase the probability, not only for the zone to hold, but also how far that reaction from the zone will actually be likely to move. So we can use market structure to help us with direction, premium and discount to see how well priced the zone is, and then liquidity sweeps and mitigations, which we will cover at a later point. So all of these are pretty nice to have, and we really do want to see them, but they do not necessarily have to be a very strict minimum requirement. But there are two main ways in which we do actually validate a strong zone. So I personally want to see at least one of these occurring in the market to consider validating and trading from a specific zone. So we want to find zones that actually achieve something very significant in the market, because this then means that they are likely to be a strong zone that had a lot of money backing that area. So the first way to see this is by looking at zones that cause a break of structure. The more significant the structure the zone breaks, then in turn, the more significant that zone will be, because it takes more money to break a strong structural level. The second method is by looking at zones that cause other strong zones to fail, and we call these flips. Now, when you combine both flip zones and structure break zones, this can give you very, very high probability zones to build trade ideas around. So over the course of the next few lessons, we are going to look at both of these two core methods in depth, and we're going to combine them with all of the other confluences that we have looked at so far, such as market structure and premium and discount.